What if the greatest economic mystery of our time isn't why things keep getting more expensive, but why every so-called emergency seems to make that cost permanent? And what if the real story isn't about inflation or debt or even governments, but about a quiet transformation of how money itself works? One that began in moments of panic and ended in a system that can never truly go back to normal, because to understand how central banks monetized crisis and made scarcity permanent, we have to rewind to a time when money was supposed to be boring, predictable, and constrained by hard rules rather than headlines and fear. When gold still anchored currencies, when governments had to persuade investors instead of their own central banks to fund their spending, and when a crisis was something that threatened the financial system rather than powered it, and the first cracks in that old world appeared not with a single dramatic collapse, but with a series of quiet decisions made in smoke-filled rooms during wars and depressions. When leaders discovered that printing money was faster than raising taxes and less politically dangerous than defaulting on debt, realization that turned central banks from cautious guardians of stability into emergency responders whose most powerful tool was creating money out of nothing. And at first this power seemed almost magical, because in the depths of the Great Depression, when banks were failing and breadlines stretched around city blocks, governments that abandoned rigid gold standards suddenly found they could spend their way out of paralysis, hire workers, build roads, and restart economies. And that success planted a dangerous seed, the idea that every future crisis could be solved the same way, by expanding the money supply, lowering interest rates, and stepping in as the buyer of last resort. Which worked again during World War II, when central banks effectively financed massive government spending to fuel factories, armies, and innovation, and afterward, when economies boomed and living standards rose. It seemed like proof that this new system had mastered the old cycles of scarcity and collapse. But the story didn't stop there, because each time a crisis hit, from the oil shocks of the 1970s to the stock market crash of 1987, central banks intervened more aggressively, cutting rates faster, injecting more liquidity, and signaling to markets that they would not allow a full-scale reckoning, which slowly changed behavior as investors, corporations, and governments began to assume that risk would always be cushioned by monetary rescue, leading to more borrowing, more leverage, and bigger bets. And this cause and effect loop reached a dramatic turning point in 2008. When the global financial system teetered on the edge of collapse and central banks unleashed tools that had once been considered unthinkable, slashing interest rates to near zero and launching quantitative easing, a process that involved creating trillions of dollars, euros, and yen to buy government bonds and financial assets, stabilizing markets and saving major institutions, but also fundamentally altering the structure of the economy by pushing money into asset markets rather than directly into wages or productivity. And in the years that followed, a strange new world emerged, where stock markets soared, housing prices climbed, and wealth concentrated in the hands of those who owned assets, while everyday costs like rent, healthcare, and education rose faster than incomes. And the longer this went on, the more dependent the system became on easy money, because higher interest rates now threatened to crash markets, bankrupt heavily indebted governments, and expose fragile corporate balance sheets, creating a trap where central banks were forced to keep policies loose to prevent the very instability there earlier. Interventions had encouraged, and then came the next breaking point, a global pandemic that froze economies overnight, prompting the largest monetary and fiscal response in history, with central banks once again stepping in to absorb massive amounts of government debt, ensuring that emergency spending could continue without immediate financial consequences. And for a brief moment, it looked like the system had achieved something close to economic alchemy. As households received direct payments, markets rebounded at record speed, and unemployment fell faster than anyone predicted. But this success carried a delayed answer to the mystery we started with. Because when supply chains strained, labor markets tightened, and demand surged. Inflation returned in force, revealing that years of crisis monetization had built a foundation where scarcity could no longer be temporary, because the underlying structure now depended on constant monetary expansion to stay upright. And when central banks finally tried to reverse course by raising interest rates and shrinking their balance sheets, the fallout rippled through housing markets, tech sectors, and government budgets, exposing how deeply the system had been rewired around cheap money. And if this story sounds familiar, it's because history keeps repeating its patterns. From ancient empires debasing their coins to modern nations expanding digital balance sheets, always starting with a justified emergency and ending with a new normal that's harder to escape. And today, the data tells a shocking version of that same tale. With global debt reaching levels that dwarf the size of the world economy, central bank balance sheets remaining multiples larger than they were just 2 decades ago, and a growing share of government budgets devoted simply to servicing the interest on what has already been borrowed, all while younger generations face higher barriers to home ownership, education, and financial security than their parents did at the same age, suggesting that the monetization of crisis hasn't just smoothed out economic cycles, but may have locked in a form of permanent scarcity, where the cost of stability is a future that always feels slightly out of reach. And that brings us back to the mystery at the heart of this story. Because the real question isn't whether central banks can respond to the next crisis, but whether they can ever stop, or whether the system they helped create now requires emergencies to justify its own survival. And from this long arc of cause and effect, 3 takeaways begin to emerge. First, debt. That money is not just a neutral tool, but a powerful force that shapes incentives, behavior, and the distribution of opportunity. Meaning that how it's created and deployed can quietly reshape entire societies over generations. Second, that short-term stability often carries long-term costs, and the decisions made in moments of panic can define economic realities long after the headlines fade. And third, that transparency and public understanding matter, because a system this complex and influential cannot remain the exclusive domain of technocrats without risking a growing gap between policy and the people it affects. And as you think about the next breaking news alert announcing another emergency rate cut or massive stimulus package, consider whether it represents a true solution or just another chapter in a cycle that keeps pushing scarcity further into the future. And if you want to keep unraveling how the hidden mechanics of money, power, and crisis shape the world you live in, make sure to like this video, subscribe to the channel, and join the conversation in the comments, because the more we understand these forces, the better prepared we are for whatever crisis comes next.